Right. So today we're diving into something kind of interesting.
Okay.
Warren Buffett's 1994 letter to Berkshire Hathaway shareholders.
Yeah.
And I know what you're thinking, right?
Mm-hmm.
Shareholder letter.
Right.
This is going to be a snooze fest.
Yeah.
But trust me on this one. This letter's like a master class in investing in business philosophy, but it's disguised as like a corporate update.
It's true.
It's so good.
Yeah, you're spot on. I mean, it's practically a cult classic in the investing world.
It really is.
And for good reason.
Yeah. And you got to hand it to Buffett, right?
Oh, yeah.
He knows how to make even the most boring topics interesting.
He does.
So 1994 Berkshire Hathaway.
Okay.
Their net worth jumps up by almost $1.5 billion.
Wow.
That's a 13.9% increase.
Yeah.
And get this, over the past 30 years, the company's per-share book value grows from $19 to over $10,000.
Now, to really grasp the kind of magnitude of that, imagine a 23% annual growth rate.
Oh, wow.
Compounded year after year.
Yeah.
That's the kind of performance that most investors can only dream of.
It makes you want to, like, invent a time machine.
Right.
Go back and invest in this company early on.
I hear you, though, even with those impressive figures, Buffett being the pragmatist that he is, he warns that, past performance doesn't guarantee future results.
Right.
In fact, he was already acknowledging even back then that Berkshire's size was making it harder.
Makes sense.
To find investments with that same kind of explosive impact.
It's like you've already found all the easy treasures.
Exactly.
Now you got to really dig deep.
Right.
You got this fat wallet, but it's harder to find places to put the money.
Right.
Yeah.
You're working with a different playing field now.
So how does someone like Buffett with a fat wallet, as he calls it, maintain that level of success?
Well, he and Charlie Munger, his longtime business partner, they don't rely on any kind of mystical formulas or secret handshakes or anything like that.
Okay.
It all boils down to mastering the fundamentals.
I like it.
Which honestly is refreshing in a world that's obsessed with get-rich-quick schemes.
Okay, so let's unpack those fundamentals then.
Yeah.
Because I'm all for simplicity.
Sure.
But sometimes we got to dig into even the simple stuff.
Absolutely. And Buffett, thankfully, is a master at clarity.
Yeah.
He says, and I quote, "Our formula, the purchase at sensible prices of businesses that have good underlying economics and are run by honest and able people, is certain to produce reasonable success."
Straightforward, yet so profound.
Oh, right.
So you're saying find a good business at a good price, run by good people, and you're good to go.
That's it in a nutshell.
I like it.
He doesn't get swayed by the hype.
Speaking of hype,
didn't
he also say that you got to tune out all that noise?
Yes.
All those forecasts?
Lots of talk.
About the economy and politics and everything?
Absolutely. I mean, those things are important.
Sure.
But they're so hard to predict accurately.
That's true.
And even when people get those predictions right, they often don't have the impact that everybody expects.
Oh, that's interesting.
Think about it over the past 30 years. We've seen wars, recessions, oil crises, even the fall of the Soviet Union.
Yeah.
Huge events.
Right.
Unpredictable events.
And yet.
Right. And yet none of those things fundamentally change what makes a good investment good.
Interesting.
Good businesses that are well managed. They weather the storm.
They do.
And to kind of illustrate that point, he dives into a really fascinating case study. In this letter. His acquisition of Scott Fetzer Company back in 1986.
Scott Fetzer. Does that ring a bell?
Yeah, so Scott Fetzer, they were...
I had to Google it, I'll be honest.
So they're a holding company. They owned a bunch of different businesses. One of them was World Book Encyclopedia.
Oh, okay.
You remember, like, the door-to-door...
Yeah.
Salespeople.
I remember those.
They also had Kirby vacuum cleaners.
Oh, yeah.
Campbell Hausfeld power tools. Among other things.
Got it. So like a conglomerate.
Yeah, kind of a conglomerate, exactly.
Bunch of different businesses under one roof.
And on paper, their book value, which basically means if you were to sell all their stuff and pay off all their debts, it wasn't anything to write home about. But what?
Buffett and Munger saw something.
They saw something more.
They saw the intrinsic...
value beyond just the numbers.
Or just the stuff.
Exactly. And they were willing to put their money where their mouth was. Berkshire Hathaway paid $315 million for Scott Fetzer. Even though the book value at the time was only $173 million.
So they paid like almost double
Yeah, they paid a hefty premium.
Okay.
Over $140 million premium.
Over $140 million.
Signaling that, they thought that this company was worth a lot more
Okay.
than what the books were showing.
Okay, I gotta ask, though.
Yeah.
That premium that they paid,
Yeah.
where does that go?
That's a great question.
Does that just...
It doesn't just disappear.
Magically disappear?
Doesn't magically disappear.
Well, okay.
It's more like accounting gymnastics.
Okay.
You have to gradually write down that premium over time.
Got it.
And that actually impacts the acquiring company's reported earnings.
So it can make things look...
It can make things look messy.
Yeah, okay.
For a while.
So how do we figure out what a company's really worth?
Right.
When you got this big chunk of change.
Yeah.
That's just like this kind of made-up premium.
That's the million-dollar question, right?
It is.
And that's why Buffett stresses looking beyond those immediate numbers.
Okay.
Understanding the underlying business.
Gotcha.
Its potential to generate cash flow in the future.
So looking at Scott Fetzer then,
Okay.
it sounds like they were doing something right.
Yeah.
Because even with that weird accounting stuff,
Right.
they still did really well under Berkshire.
Exactly. And that's the key lesson here.
Oh.
Intrinsic value is all about those future cash flows.
Makes sense.
And a great management team, like the one at Scott Fetzer,
Okay.
can unlock that potential.
So we've got to find those diamonds in the rough. Those businesses that are
Hidden gems.
hidden gems
There we go.
that have solid foundations.
That maybe the market doesn't quite get yet.
Exactly.
Okay.
And speaking of looking beyond the obvious,
Okay.
another really crucial theme in this letter
Okay.
is capital allocation.
Which is a fancy way of saying how a company spends its money.
Exactly how a company uses its earnings.
Okay.
You know, Buffett, someone who's built an empire on investing,
Yeah.
he has some strong opinions on this.
Yeah, I bet he does.
He sees a lot of CEOs getting caught up
Okay.
in this frenzy of deal-making,
Right.
often for all the wrong reasons.
Like what?
Ego, pressure from advisors trying to keep up with the competition.
So it's like, if my competitor buys a company, then
And I need one too.
I need to buy a company.
Exactly. Just to keep up with the Joneses.
He compares it to this.
Okay.
He says, it's like asking your interior decorator if you need a $50,000 rug.
Okay.
Just because you have the money to spend doesn't mean you should.
That's a great analogy.
Right.
It reminds me of that story that he tells about the CEO who wanted to buy a life insurance company.
Oh, yeah.
And when his board asked him why, he just said, "Aw, fellas, all the other kids have one."
It's hilarious, right?
It's so funny.
But it's also kind of scary when you think about it.
Yeah.
We're talking billion-dollar decisions.
Driven by peer pressure.
Being driven by peer pressure.
Wow. So if buying companies for the wrong reasons is bad,
Yeah.
what's the right way to do it?
So what's Buffett's secret sauce when it comes to capital allocation?
Yeah, what's the secret sauce?
He has this great analogy. Okay. He calls it the Wayne Gretzky rule of investing.
The Wayne Gretzky rule. I like it.
Gretzky, the hockey legend,
Yeah.
famously said,
Okay.
go to where the puck is going to be, not to where it is.
Oh, I like that.
Right. So don't just look at where
Yeah.
a company is today,
Yeah.
but where it's headed, its potential, its trajectory.
Got it.
And when it comes to actually deploying that capital,
Yeah.
his first priority is always reinvesting in his existing businesses,
Okay.
nurturing the ones he knows are already on the right track.
Makes sense.
But he also acknowledges
Yeah.
that sometimes the most lucrative opportunities
Yeah.
lie in the stock market,
Okay.
buying into great businesses at a discount.
And that kind of leads us to another important topic from the letter.
Yeah.
Compensation. How executives should be paid for the company's performance.
Right.
Buffett has some ideas about this.
He does. He's known for being pretty outspoken about this.
Yeah.
He's really critical of those compensation schemes.
Okay.
They're really complicated.
Yeah.
And especially the ones that don't align management's interests with those of the shareholders.
It should be a two-way street, right?
Exactly.
Like you can't just win when times are good and then not share the responsibility when they're not.
Precisely.
Right.
And Buffett often points to stock options as kind of a prime example of this misaligned incentive.
How so?
While they can create this situation
Okay.
where it's like, heads I win, tails you lose
Oh, interesting.
for executives.
So it's like being rewarded for something that you didn't actually do.
It's like getting a bonus for riding a wave that you had nothing to do with creating.
That's a great way to put it, yeah.
Right.
Right.
And that's where Buffett's own approach to compensation really stands out.
Yeah.
It's all about
What's his secret?
simplicity,
Okay.
transparency,
Yeah.
and direct accountability.
So you're saying like reward people for the things that they actually...
Exactly.
Yeah.
He gives this example of Ralph Shea,
Okay.
the CEO of Scott Fetzer.
Right.
He was compensated based solely on the performance of Scott Fetzer itself,
Okay.
not on Berkshire Hathaway's overall results.
Which makes sense, because why should he be punished
Exactly.
if some other company that Berkshire owns is doing poorly?
Exactly.
Doesn't make any sense.
It's about tying those incentives
Right.
directly to the areas where the manager can actually make a difference.
Makes sense.
Now, this doesn't mean that Buffett's against paying generously
Right.
for truly exceptional performance.
Yeah.
But he just believes in keeping things straightforward, logical.
Yeah. Overly complicated.
Yeah, not coming up with these convoluted schemes.
Right. Like you need a PhD to understand the compensation plan.
Right, exactly.
Okay.
Um,
This has been great, but
Yeah.
nobody's perfect.
that's right.
Right. And even Buffett makes mistakes.
He does.
And in fact, he talks about one of his big mistakes in this letter.
Yeah.
U.S. Air,
U.S. Air,
the airline.
the airline.
Okay.
Back in 1989,
Yeah.
Berkshire bought a significant chunk of U.S. Air's preferred stock.
For $358 million.
$358 million.
That's a lot of peanuts.
That is a lot of peanuts what happened.
So the airline industry at the time
Okay.
was going through this huge transformation,
Okay.
deregulation,
Yeah.
increased competition, the rise of these low-cost carriers.
Right.
And Buffett admits in the letter that he completely misjudged
Oh, wow.
how dramatically these changes would impact U.S. Air's cost structure.
So even Buffett,
Yeah.
the Oracle of Omaha,
Right.
can get it wrong sometimes.
It proves he's human.
Yeah.
Right. But what's really striking here
Yeah.
is his honesty
Okay.
and his willingness to learn from these mistakes.
Okay.
He even quotes himself in the letter.
What does he say? He says this principle should have been obvious to your chairman, but I missed it.
Wow, so he owns it.
He owns it.
He's very honest and upfront about it.
Yeah, and I think that's a really important lesson
It is.
in and of itself.
So what happened? Did they make their money back or?
It wasn't pretty.
Okay.
They eventually had to write down the value of their stake
Okay.
by a massive $269 million.
$269 million.
Yeah.
Wow.
So they lost a lot of money.
Ouch.
But he stresses that the real takeaway here
Yeah.
is that sometimes you just have to acknowledge a mistake and move on.
Makes sense.
You don't have to
Yeah.
make it back the same way you lost it.
You live to fight another day.
Exactly. Lick your wounds, learn the lesson,
Got it.
apply it to future decisions.
So as we wrap up here,
Yeah.
what are the big takeaways from this letter?
Oh, for me, it boils down to this.
Okay.
Focus on what really matters.
Okay.
Intrinsic value,
Intrinsic value.
long-term thinking,
Long-term thinking.
and tuning out the market noise.
All that day-to-day stuff, just ignore it.
Ups and downs. Yeah, just ignore them.
Ride the wave.
Exactly.
So-
And remember, even the greatest investors make mistakes.
They do.
It's how they learn and adapt that sets them apart.
It's all about continuous learning.
Exactly. Be a student of the game.
I like it.
And one final thought
Yeah.
to leave with our listeners.
Okay.
Buffett has always cautioned against timing the market.
Trying to figure out when to get in and when to get out.
Exactly. He focuses on finding great businesses
Okay.
at sensible prices, regardless of what the overall market is doing.
So does that mean that there's never a bad time to buy a great business?
That's the question, isn't it?
That's the question.
If you find a fantastic company at
Yeah.
a fair price.
Does it really matter what the market conditions are?
Food for thought.
I'll leave it there for our listeners to think about.